Hi, everybody. Let me go ahead and get started here. Nicole and Dayton, while I'm doing the introductions, could you guys keep admitting folks from the waiting room?
Absolutely.
Sure. Yeah.
Great. So thank you, everybody, for joining us for the second session of our income tax planning for farms that schedule or that file as Schedule F. This is part of our larger Cornell Cooperative Extension Farmer Tax School series. So we hope that you have seen the other workshops and have registered for those if you're interested. Tonight's workshop, you'll have Dayton, Nicole, and myself again, and we will go ahead and get started with plans to wrap up around 8:30. Just like last week, we will all kind of hang on for a little bit after 8:30 if you've got some additional questions that you would like to have answered. So just a few housekeeping things. We would ask that everybody uses the chat function to send a message. If you have any questions, we will kind of monitor that as we go along. We're going to keep everybody muted with your video off. This will help kind of reduce the background noise so it's easier for everybody to understand and hear the presenters as we go along. Everybody should have gotten an email with the session 1 recording and all of the supporting documentation from our supporting resources from that workshop. If you didn't, let me know. And for those of you that requested paper mailing of materials, those got sent out on Saturday. So if you haven't received those yet, we did find one person that wasn't getting them. So I've got to go into our system and update that. So if you requested paper mailings and didn't get them, let me know. The other thing that I wanted to add is because this workshop has gotten so much participation and you guys have wonderful questions, what we're going to do is try to keep track of all of the questions that are being asked. And at the end of this series, develop kind of a Q&A document. So all of the questions that were asked that aren't specific to a particular farm and the answers that were provided. And we'll supply that to you at the end of this series. And just once again, touching base on our big old disclaimer here. So the three of us, we are here to provide educational material, reference material, and this isn't a substitute for legal counsel or sound tax preparation by professionals. So Cornell Cooperative Extension is dedicated to providing research-based information. And every effort has been made to provide correct information, but we're still humans and errors are possible. And very briefly, I did want to say thank you to our sponsors. They helped us to keep the cost of this series low, as well as provide scholarships for folks who needed them. Our sponsors for this series include 2020 Consulting, MBT Bank, Farm Credit East, and New York FarmNet. All of their contact information will be in your slides that you'll receive, so please feel free to patronize them and say thank you for supporting the series. Okay, at this point, I'm going to turn the controls over to Nicole.
Thanks, Caitlin. All right, let's see here. Sorry, everyone, I'm just working off of a laptop today. This week, I am up in Canton, New York. So I'm not in my home office. So. Okay, so today I'm just, right now what I'm going to do is I'm just going to go over a few things that we are going to learn today. First is we're going to have an in-depth look at the Schedule F, and Caitlin's going to walk us through that. Let us understand the difference between income and expenses and how that looks. We're going to talk about grant funding and USDA payments and how that affects your income on the farm. We're going to talk about depreciation, and Dayton, I believe, will be talking about that this evening and how that is added back to your overall income. We're going to talk about some different transactions, and then we are going to finally talk about putting it all together. So what does that look like on your Schedule F? So I just want to make everyone aware as you navigate through the sections, think about how to best utilize this information for your business and really take some mental notes, because we're all going to start If you're not already building budgets for your 2022 for your bankers or looking at your first 3 quarters, you're going to be doing that awfully soon. So think about how you navigate through the sections and how your business kind of aligns with that. So that being said, I'm going to hand this right back over to Caitlin. Whoops.
Great.
All you, Caitlin.
So let me go ahead and get this poll up here. For those of you that attended last week's session, after you went through that rate your record keeping self-assessment, we want to know if you would like to share how you did. So as you went through that, if you were doing really well and got the most points, you're rock solid. If you've got some room to grow, you are adequate. And if you are just getting started with your record keeping, you might have rated as poor, and that's okay too. So that's what we're here for. Let's go ahead and log in your answers there. We do have a couple people that are struggling to get in, so I'm just trying to connect with those folks right now.
Currently, we're at 32 out of 43 participants. So we're about 75, 76% the way there.
Okay, so let's go ahead and end the poll. We can share the results with you. So it looks like we've got a good spread amongst the 3 different options. Those of the 30% of you that are in rock solid, congratulations. We're excited that you've got a solid record keeping system in place. And for those of you that are inadequate or poor, that's okay too. So I think that the biggest thing is that you kind of know where you're starting from, so we can help you get to a rock solid record keeping system. All right, so now we're going to jump back into our slides here. And what I'm going to be covering at this time, hold on one second. Yeah, we still have a couple people that are struggling to get in, so I apologize for that. Okay, so what I'm going to be covering now is talking about transactions and how they end up on the Schedule F, how they're recorded on the Schedule F. So we're going to go through kind of reviewing different incomes and expenses and where they go. And we're going to cover some examples of farm expenses and farm incomes. The one thing that I did want to share tonight, pretty exciting news in our world, the 2021 version of the Farmer's Tax Guide was just recently uploaded over the past couple of days. So we'll be sharing that link out with everybody in tonight's follow-up material. The version that you all have seen so far was for the 2020 taxes. Typically, there's not a ton of changes year to year. They do include a section in the beginning of it that kind of goes over any changes, but we'll share this out just in case anybody wants a little bit more light reading on the topic. Okay, so thinking about your farm business and the record keeping that we kind of touched base on last week, we've got all these incomes coming into the farm and all these expenses leaving the farm. And anything that relates to the activity of farm production can be recorded on the Schedule F. So examples of income that we include on the Schedule F, probably the one that's the most obvious is the sale of farm products. So whatever we're producing on our farm, selling those, that income gets recorded. So these are items that you grow or raise on your farm with the purpose to sell them. If you purchase items and you sell them in the same year, So it's not something that you raised on your farm. Those are also claimed on your Schedule F. If you purchase something that is sold later on, so this would be some breeding livestock would be a good example. They're going to go on the form 4797 in most cases. So here's an example. If you are raising beef cows and you buy a cow-calf pair, your intent is to keep the cow for breeding stock and to sell the calf as a feeder steer later that year. The calf's income is going to be claimed that year on the Schedule F versus the cow. If you're planning to hold her for breeding stock, you're not going to claim her income until later on if you do decide to sell her. Other incomes that aren't quite as straightforward as selling the products that we raise include some rents. So this one's a little bit tricky and is case-by-case basis. If you're simply renting out land to another farmer and you have no management of that land at that point, it is not claimed as farm income on your Schedule F in most cases. If you are renting out land that you do have management control over, that does get claimed on your Schedule F as farm income. So an example of this is if you had some pasture land that you were renting out to another farm, and at that point you were responsible for keeping track of the animals that are on the pasture, maintaining the fence, things like that, that is considered an income for your specific farm business. Other incomes, agricultural program payments, which Nicole's going to get into a little bit more later on, including CFAP, depending on the program. So some programs for example, cost share conservation programs, some of them are not claimed and other ones are. So this is again, a gray area that you get to have a really good conversation with your tax accountant. And this is why we definitely encourage you to work with an accountant that's familiar with farms and familiar with these different programs through organizations like the USDA. Okay, so other incomes that are claimed on your Schedule F include crop insurance payments and income from cooperatives. So if you're, for example, selling your milk to a milk cooperative or purchasing feeds from a feed cooperative, any patronage dividends, oh my gosh, I can't talk tonight, guys, that you get, you are going to claim those as a Schedule F income as well. And they should be filing a 1099 for you before the end of January of the following year. So then you can claim that, go ahead and claim that on your Schedule F. Okay, other incomes, any cancellation of debt with an asterisk. So PPP debt, which Nicole's going to cover later, you do not need to claim that as an income because it's considered a forgivable loan instead of a cancellation of a debt. And in cases of bankruptcy, you also do not have to claim canceled debt in that situation for the most part. This one gets a little bit tricky and a little bit into the nitty-gritty. So for bartering income, you do need to claim the fair market value of that barter. An example of this, let's say you have a farm neighbor, you are going to mow and harvest their hay ground for them, and they're going to give you half of a freezer beef cow in exchange for that. Most of the time, those kind of transactions go a little bit under the table, but according to the IRS and how we should be doing our record keeping, you should be creating a paper trail for that transaction using the fair market value. The reason for that is that, it costs you money as the farmer to travel to your neighbors to harvest that hay, and it costs your neighbor money to raise that beef cow. So, recording the fair market values of that is important for your own farm record keeping and financial analysis, but that also does count as income. So the best way to do this, in my experience, is just to write a receipt for, give your neighbor an invoice for your services and have your neighbor give you a receipt for whatever you receive in kind. There's no cash exchange, but having that paper trail is a good way to maintain your records. Any income from commodity futures and options is claimed on your Schedule F for the most part. Sometimes if you are doing really well with futures and options, you might consider breaking apart those two separate businesses. But that's usually a conversation to have with your tax accountant, depending on your income streams. Other incomes include custom hire. So, in that situation I just described, where maybe you go to a neighbor's and you help harvest crops, that income that the neighbor would pay you for that service does get claimed on your Schedule F, as long as you're using machinery that you own and employees that you pay. Sometimes easements and right-of-ways, depending on what property they're located on, and it's that property's relation to your farm business, are also claimed as incomes on your Schedule F. Prizes and awards. So, if you raise goats and you take your goats to show them at the county fair, those prizes and awards are claimed as incomes on your Schedule F as well. And then any refunds and reimbursements, particularly if it's, let's say you buy a product and you're going to claim that product as an expense on your Schedule F, but it's defective for whatever reason, so you're given a refund, you should be claiming that refund as an income on your Schedule F, which will offset the expense of the original purchase. Okay, so now to the not so fun part of our Schedule F, and that is the expenses. Again, this is just an overview of the different kinds of expenses that we might see on our Schedule F. In general, any ordinary or necessary cost of operating your farm for a profit, or with the intent to earn a profit, is considered an expense that should be recorded on your Schedule F. There are cases, because this is the one that I always get asked the most, where your personal expenses could have a business share. Some examples of this are water, electricity, phones, insurance, interest, taxes, so utilities, taxes on land that maybe your personal home is located, but you also are operating part of your farm off of it. There's no set allocation for charging those expenses on your Schedule F or breaking them apart when they are a mix of personal and business use. Only what is reasonable. And this comes straight from the Farmer's Tax Guide. So the IRS is not providing any, outright structure that says, okay, let's say you, for example, use your electricity for both your personal home and for your farm. There's nothing from the IRS that says 50% of it can get charged for your farm business use. What we do here is kind of use our best reasonable effort guess to establish those allocations and then follow those allocations in the future. Working with a tax preparer that is really used to working with farms, especially farms of your size and your commodity group, is really helpful in this case, because they're going to have a better understanding of what those breakups might look like. In this situation for phones, for example, cell phones, if you have a cell phone, but you don't have a separate one for your business and you're using your personal cell phone for business use, you could claim a certain percentage of your personal cell phone costs for your business and record those expenses on your Schedule F. Okay, other expenses that show up on the Schedule F. Last week, Dayton talked about prepaid farm supplies, which could be a really good tool to help manage your tax liability, as long as it doesn't exceed 50% of your total expenses for that year. Hired labor wages, repairs and maintenance, except for large capital expenditures. So I've got this picture of a very representative tractor on some of our farms, right, that were kind of held together by bungee cords and duct tape. If you have equipment or a barn where you're replacing a tire, you're replacing a few shingles, those repair and maintenance costs get reported on your Schedule F as an expense. If you're doing a large repair, so you're completely overhauling the entire tractor, you have to replace an entire roof on a very large barn. In those cases, when you're doing a large capital expenditure for a repair or maintenance effort, those are actually can be recorded or captured on your Schedule F through depreciation, which Dayton will be talking about later. So those are all kind of based on the total cost in comparison to the size of your farm business. So again, you're going to hear me say this a lot, working with an accountant that's familiar with farms can go a long way here because they can help you navigate, is this a typical expense or is this something that I need and should depreciate out? Interest with some limits. So let's say you have an equipment loan on your farm for a new combine. The interest that you pay against that loan is an expense that you can claim on your Schedule F. The principal payments, which we'll be talking about later, are not something that you can claim. Fertilizer and lime, which is pretty straightforward. And then taxes for the farm business. So a portion of your real estate and personal property taxes can be claimed for the farm. Again, this is kind of in relation and allocation between that property that's being used for the farm and the property that's being used for your personal use. Your state and local sales tax can also be claimed as an expense. For cash flow purposes, it's better if you don't pay them in the first place. So this is my shameless plug to make sure you've got a few copies of the ST-125 and all of your vehicles that you use for your farm, and use those so that you don't have to pay sales tax up front. If you visit a vendor where you do end up paying sales tax, that sales tax can then be written off as an expense on your Schedule F. Any amounts of Social Security or Medicare that you withheld on behalf of your employees can be listed as an expense. Highway use tax for your trucks that are used for the farm business can be an expense. You cannot deduct self-employment tax as a farm business expense. And this one I'm not going to touch right now because we have a few more slides later on that go even farther in depth on this. Insurance. So this can be property insurance, crop insurance, livestock insurance, and health or disability insurance on your employees. You cannot claim insurance on yourself if you are a sole proprietor, owner of the business. Rent and leasing is an expense that you can claim on your Schedule F. This could be for equipment or for land, and of course, depreciation. So Dayton will be covering this later on. This is for most purchases that have a useful life of more than a year. So it's not a product that you're going to purchase and use right away. What we can't do is, for the most part, claim the entire expense at once. Truck and car expenses are also something that you can claim on your Schedule F. There's two different ways that you can do this for cars and light trucks. You can either take the federal mileage rate, which changes every year. I think it's 56 cents right now. So what you would do is claim, I drove 10,000 miles last year for my farm. I have documentation to prove that, which can just be a mileage log that you keep in that vehicle. And I'm going to claim the federal mileage rate at 56 cents a rate. The other thing you can do is claim the actual cost. So if you have a vehicle that is mixed use, farm and personal, you know that 60% of the time that vehicle was working for the farm, not for your personal use. You can claim 60% of the cost of that vehicle. So fuel, maintenance, tires, repairs, inspection, registration, you can claim a cost of that or claim mileage. This is where having really good records is helpful. So if you can run a quick, tally to see which one is going to be worth more to you, claiming the mileage rate or claiming the actual cost, it can be a helpful tool as you're filing your taxes. Travel expenses. So if you're traveling for a farm-related meeting with an overnight stay, the hotel and your meals could be claimed on your Schedule F. And marketing quota penalties if they're not already included in your gross income. So this probably for most of us in the room, this comes to mind with our dairy farms that might be receiving marketing quota penalties currently. A lot of times those are actually taken out as part of your gross income. So you're not receiving a separate bill for that. You're just receiving a lower price for whatever milk you're selling over quota, for example. So in that case, that loss is not, you're not able to claim that as an expense. If you are overselling marketing quota and they're giving you a bill for that oversell, that's when you would be able to claim this on your Schedule F. Items that you purchase for resale within the same year. So let's say you purchased some beef calves that you're going to feed out a little bit and then resell them. Those are expenses that you're going to claim right on your Schedule F. Any accounting, record keeping, and attorney fees are all things that you can claim. Advertising for your product, consultant fees. This might be a crop consultant, a livestock consultant, cooperative dues, educational expenses. So here's my shameless plug. All of you hopefully kept the receipt for this series. That's a cost that you can claim against or claim on your Schedule F. Farm magazines and memberships to organizations that are related to your farm business, insecticides and chemicals, bedding for your animals, marketing fees for your product, service charges, stamps and stationery, small tools, loan expenses, including fees, commissions, and interest. Tax preparation, if you're a sole proprietorship, this is another expense that you can split between your business and your personal use. So if you go to a tax preparer, they're going to prepare your personal taxes as well as run your Schedule F for your farm business, for example. You can split that out. But what we need to do is pay attention to capital expenses, things that we're purchasing for the farm with a useful life of more than 1 year. In that case, we're going to cover more of that later. But in general, any expense that you have for your farm that's a reasonable and necessary purchase for your farm to stay in production, and you're working towards making your farm profitable, those are all things that you can claim on your Schedule F against the farm business.
So Caitlin,
Yes.
before we move on to grants and government programming, Bill asks, can a contractor repairing / expanding, whoops, that popped up, expanding my barn electrical systems can be claimed as an expense, or should they be treated as a capital improvement?
Yeah, Dayton and Nicole, you guys can jump in too, but in that case, it really does depend on the cost in comparison to the rest of the costs that you have for your farm business. So if it's really going to be a drop in the bucket and it's a minor repair, that's something that we claim right away. Larger repairs, because something like that does have a useful life of more than 1 year, would be something that we would depreciate out if the cost is large enough to justify to do that. Dayton, Nicole, you guys on the right track?
Yeah, Caitlin, I would say the same thing. If it's a significant investment and it's something that you might be able to depreciate, then I'd call it a capital item. But if nobody on the IRS is on the call and you're trying to manage tax liability, maybe you might want to call it a 12-month expense.
Yeah, that's why working with your accountant is really important, because they would be able to tell you, how you should do it. And then at the end of the day, you have ultimate say. So some things you may want to depreciate out and others you may not. I mean, and that can also come back to loan officers. And if you have a really heavy, expense for the year, say for building and supplies, and that's kind of thrown in there, they may question that. They may say, why didn't that get depreciated out? So under capital expenditure. So I guess that's it. That's why working with your farm accountant, Dayton, Caitlin, you guys can both agree or disagree. So is important.
Yeah, that's always a gray area when you're making a capital improvement to a building or something like that. That's kind of a gray area that you have to make a judgment call. But hey, Caitlin, I want to talk about, can I give you an example of cancellation of debt?
Please do. Thank you.
Because I'm working with 3 brothers who are farming, and one brother left the farm and he was relieved of a debt obligation, very significant debt obligation through leaving the farm. But what he didn't count on is that counted as income because he was relieved of that liability. So all of a sudden he gets faced with this huge tax liability, and he's on the floor saying, oh no, what am I going to do? but the IRS worked with him, and I think he ended up terming that out over a 10 or 15 year period. So he has to pay, a lump each year. But here he thought, I'm leaving, I'm getting relieved of this debt, and man, they got him. So
Yeah, very good.
Yeah, that's why, good transition plans are really important when you start work. If people do something like that, we always tell people, Dayton, Caitlin, and I, is you better go visit with your accountant before you do any kind of major changes like that, because it can be very impactful, over your lifetime, and your body of work can be very impactful with your taxes. So there.
I did have another question from Felicia. Farm use for your vehicle, is that considered delivering products and going to pick up supplies, like going to the vet or feed mill as well? Yes, so anytime that you are using a vehicle for a necessary part of operating your farm business, that mileage or cost share of that vehicle can be claimed as a farm expense. And the examples that you provided all count. So I joke with my accountant that I have to go pick up my kids from school because they're necessary farm labor as part of our farm, and he does not go for that one. So work with your accountant, but pretty much anytime that you, that was a joke. I should have clarified that. Big old asterisk joke. So anytime you're using your vehicle for a necessary purpose of your farm, you can claim that.
And that includes going to the bank or post office or anything like that. That's all considered in the realm of your business. And I think there's one more on there too from Mark. Caitlin, do you want to read it, or would you like myself or Dan?
I'll read it and you guys can answer it. So Mark says, my farm is a vineyard winery. It will be 4 years before I have a crop to sell, and another few years before I have wine to sell. Can I carry my expenses from years 1 to 4 plus to use against the income I will eventually earn? Can I begin to use expenses on my personal income taxes through Schedule F before I generate income?
So I can take a swing at that one. Yes, I think because it's a vineyard, talk to your accountant again, but I'm pretty sure you can show a loss for a number of years because you don't have income producing assets yet because of that situation. So I don't think the IRS would bother you if you showed a loss for a number of years going forward. So you could show your expenses without, income or much, but talk to your accountant.
Yeah, I think they do that for like Christmas tree farms and the like also. I think that kind of falls under the same category if I'm remembering correctly.
Okay. All right.
All right. So I think I'm up.
Yep. Go ahead, Nicole.
Okay. So I get the, all right, I get the job of talking about grants and government programs. And this was something that was brought up pretty heavily last week. If you notice down on the bottom, it says the USDA NRCS. A lot of people may get some cost sharing. Some folks get their county soil and water conservation. There have been grants for manure storages, and they are on a cost share type basis. And then we all know about the CFAP monies that came out, dairy margin coverage monies that have rolled into dairies. So let's talk a little bit about those programs. So the first thing is, how do grants and programs affect income? Well, unfortunately, and most people don't like to hear this, but those grants and programs that come from the USDA, NRCS, any kind of grant funding or dollars that come into your business, that is all considered taxable income. You will receive a 1099 form from your county soil and water commission if you did a grant program with them. If you have anything with NRCS or USDA, you'll receive a letter in the mail that has to go to your accountant signifying the funds that you received. A lot of people are receiving funds currently if they haven't already. for crop reporting. So those dollar amounts are taxable and need to be reported against your annual income. How do I notate those for the accountant? So there's a couple different ways to do this, and it's really important that you signify that on if you do QuickBooks or a Quicken program, or even your Excel files, if you have something that, you know, allocates that, lumps it out, and just doesn't throw it under income. But also make sure that you're sending all the documentation and keeping all those papers that come in the mail for your accountant. So if you get a stack of those USDA papers, I think a lot of people have seen them. I think a lot of people have gotten them probably in the last couple of weeks or last week or so. Make sure you take that piece of paper and you slip it into a tax file. Everybody should have a tax file that needs to go to the accountant with, you know, your property taxes, school tax bills, this type of information. That way your accountant can see that, just have it compiled and neatly organized. Another thing that we like to talk about, because some of our programs aren't just, you know, the CFAP money was kind of deposited right into folks' accounts, but NRCS and Soil and Water, if you do cost sharing programs with them, you typically have there's typically an 80-20 or a 50-50 split where you have to come up with 50% of the funds, and you know, you receive 50% of the funds from the program. That program, you can offset some of the costs on your expenses. Say if you're building fence, or if you're pouring concrete or something like that, if it's some type of project, you can cost share that out. You can do a capital expenditure like Dayton and Caitlin were just talking about a few moments ago, but cost share programs all have to be on your taxes. That's why working with an accountant that understands the different types of programs out there for farmers is really important. But making sure you notate all of that is, you know, primary with this. So the other one that a lot of folks were able to capture was the Paycheck Protection Program. And this one is a little bit unique because the fact is that initially it's a loan. So we have to go to the bank or Farm Credit, or some people did it through some third-party companies, but it is initially a loan. So we were all taking out loans, or folks were taking out loans for this paycheck protection with hopes of receiving full loan forgiveness through a grant program through the SBA. So the 2020 grants, most of them have been, people have already submitted applications for loan forgiveness. Folks that I've talked to have received full loan forgiveness. Now, folks that received 2021 grants, they will be starting, or 2021 loan/grants will start receiving applications for forgiveness. But what the nice thing about this is that those forgiven loans are not considered taxable income. The federal government made a change to their policy back in December of 2020, just before the 2021 new year. And they said that we are not going to consider that taxable income. You were able to write off any of the expenses that had incurred. So actually a lot of businesses, that helped a lot of businesses because it was almost like a double benefit to them. So forgiven loans are not considered taxable income. However, you still should allow or let your accountant know if in fact you received one. Have all of your loan forgiveness paperwork available to them so that they can see it and understand it. It's always nice to be open and honest with them, because they're the ones that are working for you and working toward getting your taxes in order. So with that being said, I think there's some more in the chat box here. Caitlin, did you already answer that?
Yeah, so Jill made a really good point that we should clarify. if you are claiming the expenses related to operating a vehicle, so things like changing the oil, fuel, registration expenses, you cannot claim mileage as well. So you have to pick one or the other.
That's true.
We also, I just wanted to share really quick, we had a request to offer the live transcription services through Zoom. If you want to toggle that off, if that's distracting for you, if you go to your screen, there should be a little CC button and you can turn it on or off.
Great. Thank you, Caitlin. So I'm going to stop share so that Dayton can go right ahead and share.
All right, thanks, Nicole. All right, I'm gonna back up to where you were. Okay, how's that? Can you see it?
Yes, perfect.
Okay, all right. So just going to talk about capital purchases and sales. So at this point, I think everybody knows a capital item is a tangible item with more than 1 year useful life that you use in your business. So tractors, buildings, livestock. Capital items are expensed through depreciation. So that's how that happens. And I'll again, the example from last week, and I'll talk more about it this week. If somebody's doing some year-end tax planning, makes a capital purchase, they can use depreciation to expense that. If you sell a capital item, can be subject to capital gains tax, as we mentioned last week. Nicole mentioned, or Caitlin mentioned, Form 4797 for livestock. That's where capital sales of livestock are reported. Land is not depreciable. However, land taxes, your property and school taxes can be counted as an expense, which Caitlin mentioned. So, all right. Loan principal and interest, and this is an interesting one. Interest, or I like to call interest the rental fee for using somebody else's money. So if you're paying interest to use somebody else's money, you are able to expense that as an operating expense. However, the principal portion is not an annual operating expense. And I give you an example here, which I've run into numerous times. And I know there's a lot of verbiage on this slide, but let me just get through it with you. So the farmer says to me, hey, I was having a really good year, had a lot of money, so I decided to pay down some extra principal on my loans. That's really good because it gains equity and gets rid of some of that liability risk. However, at the end of the year, I had to choose to pay income tax or prepaid expenses. Again, the choice to pay income tax or reinvest in my business, but the farmer didn't have any money to do it because he paid down his principal on his other loans. So again, the point here is use earnings to pay down principal. Principal is not counted as an expense. So what it looks like at the end of the year is actually the business did really well. And the farmer says, well, I have no money. So they had to borrow money to do tax planning, which is a fairly common thing. So just a word of caution there that principal debt is not able to be expensed on Schedule F, only the interest portion. Let's see, owner withdrawals. Let me see, let me back up. All right. All right, here, just want to got a couple slides there. So it kind of depends on business entity, and I'll just go through a couple here. So with a sole proprietorship, basically any Schedule F line 34 net profits will will flow to you as an individual. So with a sole proprietorship, the owner cannot be an employee of the business. So we're not able to expense owner withdrawals as a sole proprietor. With a partnership, same thing. The earnings from Schedule F will flow to the partners. And again, not able to expense owner draws within the business. All right. And so in LLC, let me just talk a little bit about this one. So with an LLC, the interesting thing about an LLC is it's the most flexible organization on the planet. You can do a lot of things with it. One of the things you can do with an LLC is tax it really any way you want to. An LLC can be taxed as a sole proprietorship, as a partnership, as an S Corp, or in fact, a C Corp. So my answer here is, and I've not seen an LLC taxed as a C Corp. All the LLCs that I've seen tax returns for are generally taxed as a partnership. However, if you wanted to tax your LLC as a C corporation, you could include the owner as an employee. And I'm not sure the advantages to that. Maybe that would be a question for Paul next week. But if the owner is an employee, then you have workman's comp, then you have all these, all these Social Security and Medicare and all these things, federal unemployment, state unemployment. So I'm not sure why somebody would want to do that. A C corporation, you can expense owner withdrawals. A C corporation, the owner is considered an employee of the business. And like I said, S corporations, the ones that I've seen are taxed generally as a partnership where earnings flow down to the individual partners. All right, and let me see. Hold on. You know what, Nicole, I may have skipped ahead. I missed it. I missed some slides. Let me go back. Oh, go ahead.
I know there is a question in the chat box from Phil. Maybe you want to.
Oh, yeah, let me have it. What's the question?
All right. Could you give an example of depreciation recapture as related to sale of asset?
Well, I think so. Yeah. I think I got through all my slides for this section, right?
Yep.
Yep. So Phil, let's say that, so I bought a tractor, IH 1066, no, yeah, John Deere 4020, right? $12,000. And one of the nice things about the John Deere is that it tends to hold value. And my crazy neighbor came and he bought it from me 3 years later for $12,000. So or for, let's say 14,000. So I paid 12. My neighbor bought it for me for 14,000. So the $2,000 would be considered capital gain. So that would be a capital gain. However, let's suppose that I was able to depreciate that down to $10,000. Or well, yeah, let's say I depreciate it down to $10,000. The $2,000, the difference between the 12 that I paid and the 10,000 that I depreciated, that $2,000 would be taxed as regular income and called depreciation recapture. So I don't know if that was complicated or not. Tell me, I'll try to. So it'd kind of be a two-part thing. Because I sold it for more than I bought it for, that amount would be capital gain. And then the difference between the depreciated value and what I paid for it, that'd be called depreciation recapture. And that would be counted as regular income at regular income tax rates.
Yeah, that sounds right, Dayton.
Yeah.
I have another one
Phil,
from, go
okay,
ahead.
yeah.
Phil said, yes, good
Phil,
example.
all right.
Yep, he said good example. So yeah, that makes sense. So people can understand that, especially when you're talking about tractors, because that is happening, especially
Yep.
those older tractors. So Barb, just to kind of go off of that, Barb says, well, what if you sold it for 5,000? So use your same example, but selling it for 5,000. So what would happen?
Yes. Yeah. So I would, really, you wouldn't know anything.
Right. Exactly.
There'd be really no gain there for you at all. Yeah. Yeah.
Exactly.
I mean, the only thing you would have benefited there. Yeah. Yeah, so well, the only thing I could say is, yeah, no gain. No gain. So no tax liability, nothing to worry about.
Dayton,
the
there would
benefit was
actually
you
be
got
a
to-
loss if you sold it for 5,000 because you would still have some
is
basis.
this
Basis
Joan?
would still be
Yeah, Joan.
10,000. So
Okay.
the basis at 10,000, if you sold it for only 5, you would have a $5,000 loss that would work its way through on the form 4797.
Okay, Joan, thank you. Now, Joan, let me ask you a question. What if I had it depreciated down to say 4,000 and then I sold it for 5?
And you sold it for 5, then
Yeah, so
the 1,000 that you had claimed already in depreciation, or that had been claimed in depreciation, anything over your basis up to the original sale price would be ordinary gain.
so that 1,000 would be ordinary, but there'd really be a capital loss too.
Well, there's no capital loss. There'd just be an ordinary gain because you'd already depreciated it down to less.
Okay, all right, that makes sense. Does that help everybody in the audience? Joan,
That one's a
thank
tricky
you.
one. I'm just gonna say those are tricky. But one thing I will say to folks is the backside of 4797, if you know your basis and you know what you paid for it originally, and you know what you got for it, if you follow those lines, line by line by line, you will come up with how much it'll separate out the capital gain from the ordinary gain on any of those items, or if you have an ordinary loss.
Right.
Thank you,
Joan,
Joan.
can you introduce yourself? Can you just tell people who you are?
I'm Joan Petzen with the Northwest New York Dairy Livestock and Field Crops team, and been doing this kind of work for probably longer than I should be.
Yeah, so Joan is our colleague, and she's not just some crazy person interrupting.
Which, shameless plug, Joan's going to be teaching the next course in this series in December. That's all going to be about keeping for tax management. So if that's of interest to you, please attend, because Joan's a wonderful person to take a course with.
Absolutely. So I do have another question, Dayton.
Yep.
Kathy says, by taking draws in an LLC that aren't deductible, aren't you eating away at your equity? But LLC advantage is reduction of liability.
Well, so yeah, so not to get into this too deep, I don't know that I can get into it in the weeds too much, but so a member of an LLC will have what's called a capital account, and taking draws will go against, well, it depends, but can go against the capital account. However, the capital account can grow. I'm not going to answer that. Ask Paul that one next week.
Yep. I'll save that one for next week.
All right,
Yeah,
Kathy,
so-
we're going to say that for next week for Paul.
Yeah, so it's actually there's a nice formula that takes the LLC member's capital account and takes out draws and adds in earnings from the business. And so if the member says, well, I'm not going to take much of a draw, but I'm going to put the earnings back in, that grows their capital account. So it's there's a formula there, and I've seen them and looked at them, but I can't say it to you right now.
Perfect.
Yeah.
Great. Okay. So,
so I have a break here, right? And then come back later.
yep.
Okay. I'll stop share.
All right. So along the same lines, we're going to talk very briefly about, about how you can record a tax refund or a tax payment based on, or as it relates to your income tax and filing Schedule F. I'm just going to caveat this whole slide with, at the end of the day, talk to your accountant, because It's going to depend, for example, we were just talking about LLCs and how they can be structured differently. So this all depends on your business structure. So in general, claiming a income tax payment or an income tax refund depends on the business structure. Only a farm business that's filing as a C Corp will pay its own income taxes. And in that case, it's recorded on the balance sheet. If you are due a refund, it's recorded as a current asset, as an accounts receivable. And if you have to pay into your income taxes, it's recorded as a current liability, as an accounts payable. So for everybody else, sole proprietorships, most LLCs and most partnerships, your tax refund that you would receive. So you go in, you do your taxes, your accountant says, okay, you're going to get $10,000 back on your taxes this year. That refund is a personal transaction. That's not a transaction against the farm business. So you might have gotten that refund because the farm took a loss that year, but that money is not considered income for the farm. That is a refund on your personal tax liability. So a refund is a personal transaction for an overpayment of your taxes. That refund should get deposited into a personal account because that is not income from the farm. That's your own personal refund against your own personal tax liability. Now, if you end up having to pay into your taxes because the farm did really well, we're going to show a big profit on our Schedule F. It's going to help us with our, borrowing capacity in the future. If you are in a situation where you have to pay into your taxes, again, as a sole proprietorship filing a Schedule F, that's a personal transaction. So the farm does not pay that income tax liability. You as a person pay that income tax liability, and it should come out of your personal funds. All of this said, you can reinvest a refund that you might receive or take a draw from the business to cover those tax liabilities or the refund, just as you would incorporate off-farm income or take a family living draw. You cannot claim state and federal income taxes as a farm business expense. They can be claimed in most situations as your at least for your state income taxes up to, I think it's $10,000 as a personal expense, but it is not a farm business expense. So the whole reason for this, if we think about it this way, when you're filing a Schedule F as a sole proprietorship, this is something that is adjusting your personal income from which you're going to pay your income taxes or get an income tax refund. So at the end of the day, double check with your accountant, but for the most part, the farm business itself is not taking a refund into its checking account and it's not paying income taxes. Okay, Dayton, I think that we're gonna switch back over to you. Any questions on that? Because it kind of follows along what Dayton was talking about as well.
I don't see any
Right,
questions,
Caitlin, let me
Dayton.
get back.
Perfect.
Okay, let me get. Okay.
There you go.
Let's see, slide here.
So while we're waiting
All
for
right.
Dayton, we do have
Oh,
a
geez.
question.
Hold on.
Is the
Yeah, go ahead.
farmer's
I'm getting
tax,
there.
is the farmer's tax refund taxable?
Okay, I'm going to try this, but if I explain it wrong, it's because I'm not an accountant. So it's not taxable because it's just going to reduce your personal wages income that you're getting taxed for. Am I explaining that right, Dayton and Nicole?
Oh, geez.
Yeah, it's like, yeah, you're decreasing your taxable liability. Yes.
All right, I'm almost there. I've almost got it. Hold on.
You're good. You got this, Dayton.
All right.
You're good.
Yay, I got it. I know. All right. Okay, so one of my things that I really like about taxes is depreciation, and it allows you to reinvest in your business and offset income tax liability. And I'd say it's probably one of the most popular popular items that farmers use. And this is some verbiage right from the IRS website. And section 179 is a depreciation law, IRS law, that allows you to rapidly depreciate an item. And for 2021, the deduction limit was $1,050,000. And I just want to give you a little background on this. So when I'm really old. So when I started working out of college, I was working with a lender, and the section 179 depreciation expense at that time, I believe, was 19 or 20,000. So this rule encourages reinvestment in business. I cannot say this enough. This rule encourages reinvestment. So when my buddy calls me, my buddy Travis, my neighbor calls me on December 26th and says, hey, we got to take a road trip and we got to buy $150,000 Steiger tractor. This rule says that as long as that item is placed in service prior to the end of the year, he could depreciate the full amount right away. So it's really a powerful income tax management tool. And placed in service is kind of gray. I would say he's taken delivery by the end of the year. So, yep. So just won't get in the weeds too much on these, but if you look in your publication 225, you'll see two depreciation systems, the GDS, general depreciation system, and generally I use the general system unless required to use ADS, which is the alternative depreciation system. And within that, under that ADS umbrella is the modified accelerated cost recovery system. And just my main message here is just to let students know that the IRS has very strict guidelines for depreciating assets, which your accountant will know well. This is a table, and I hope you can see it okay. This is a table from publication 225, and my intent here was just to show that under the general depreciation system and the alternative depreciation system, the IRS puts forward a depreciable life of assets. So I just kind of go down through a couple of these here. Ag structures under GDS are 10 years, under ADS 15 years. Cattle, dairy or breeding 5 years under GDS, 7 years under ADS. Just to give you some examples. New farm machinery, 5 years under GDS, 10 years under ADS. So just to give an example, the IRS is very specific on the length of depreciation for assets. And just some more things here. Let's see, declining balance, half-year convention. This essentially means the item was placed in service midway through the year. And the amount of depreciation is heavier at the beginning of the asset's life. So they called the declining balance, 150 declining, but just kind of sharing these with you just so you kind of have a general concept. The straight line method is essentially equal amount every year. The reason that these amounts aren't equal is because it's a half-year convention. It's placed in service midway through the year, but straight line essentially is the same amount of depreciation each year. So just two methods there. And, oh, is this you, Caitlin?
Yep, it is. In the interest of time though, because we've got
Okay,
really great questions, I think what we're gonna
okay,
do is we're gonna skip past the activity that we had planned and skip past our break. And Dayton, if you want to, you can just jump right into your next session or section. If anybody does need
okay.
to take a break, feel free to stand up, get the wigglies out. We are recording this session. Everyone's got the slides, but just in the interest of time, so we've got enough of a chunk at the end for Q&A. Let's continue moving ahead. Thank you, Dayton.
All right. All right. Yep. Sounds good. And so kind of we think about how does the Schedule F relate to the amount of income taxes that you owe? And I just want to kind of walk us through the forms for a federal tax return. So I think you've seen this before maybe, but this is a Schedule F, profit and loss from farming. And this is for 2020 accounting year. On the top side is and this is a cash method, meaning, we record cash when we receive it and we record expenses when we pay them. Farm income on top. It's just like an income statement, and farm expenses on the bottom. And really at the end of the day, what we're trying to do to manage income tax liability is control this line 34, which is net profit and loss. And as a lender, what I would do is I would immediately take a look at line 34, and then the next line I would look at is line 14 and see how much depreciation was there, because you're trying to figure out cash available in the business. And if there was a loss here, but we had $500,000 of depreciation, because that's a non-cash expense. It's a long story, but so this is a Schedule F. So not to get off on a tangent there. And the IRS, I'm not sure when it was, but I think it was 3, 4, maybe 5 years ago. They changed the 1040 a little bit. The Schedule F used to flow directly to the front of the 1040, but now it flows to what's called a Schedule 1. And Schedule 1, line 6, line 34 from Schedule F will flow to Schedule 1, line 6, which is farm income or loss right there. So that's that. And Schedule 1 will flow, you'll see, to the front of Form 1040. So here we go. And Schedule 1 is right here on 1040. So that's where it goes. As you can see, there's a lot of other things here. So we're getting the Schedule 1 income, which we would say is profit, or the profit or loss from farming is carrying to the front of the 1040. And we could have a wage income there. Somebody's working off farm, earning a wage, IRA distribution, Social Security benefits, all this kind of stuff. And then we get to take out our standard deduction or itemize whatever you are going to do. And we get to a taxable income. And then on the back, we can take that taxable income and massage it a little bit through credits and things like that. But there you go. So that's real basic, and how Schedule F connects to your 1040. And then I just showed the back page of the 1040 to once we have a taxable income, we can adjust that for various things. Like I remember our guest speaker next week very clearly telling me that a credit is a dollar for dollar reduction in the amount of income tax liability that you owe. So we love credits. And so then at the end of the day, and I think most of you have probably seen this, how much did you pay in? And I know everybody's excited when you get an income tax return, you get money back from the IRS. And my goal is to get no money back from them. My goal is to owe just a little bit. And the reason is because if you get money back, that means you overpaid. And so I don't mind paying them a little tiny bit at the end of the year, because that means that I got to use my money for the whole year and not them. So as they are not our, they're not, they just want our money. So not to get off on a tangent there. So there it is. That's how that all flows together. And I would encourage you just to check out publication 225. So I think, Caitlin, that's it.
Yeah, thank you.
Yep.
So we have a couple questions in the chat that I just want to touch in on first, and then we will work on wrapping it up and open it up for a big Q&A. So
Oh,
Barb,
sorry, yeah.
really good question, and I've gotten myself turned around on it. So Dayton and Nicole, you need to save me. Her question was for New York State property tax and school taxes on your New York State tax return. You know, those expenses, which I touched on, those can be shared amongst based on that land and its use. But for in the case of a refund, how is that handled? So is that considered income or a share of income? Your guys' thoughts on that?
So Nicole, can I give it a try?
I'm
Yep,
rereading the.
okay. So, and the way that I understand that is you must pay the taxes to get the refunds. You pay them, you get a refund, and that refund counts as income. I think that's the way I understand it. So the farmer's school
You're
tax
absolutely correct,
refund.
Dayton, because you claimed the deduction, you get the credit. Yep.
Thank you.
Yeah,
Jo-
Thank you,
that's
Joan.
considered taxable income. That's correct.
Yeah.
Yep.
Yeah.
So the other question that we had from Philip was, how many years can you carry forward a loss from farming?
Boy, I'd say ask Paul next week.
I'll put that as on our list of questions here.
Yeah.
I was thinking 3 years was like sticking in my head, but that's definitely a Paul question.
Okay. All right, so we're going to kind of do our conclusions and our wrap-ups here, and then we'll open it up for even more Q&A. So first, just to kind of everybody take a break and reflect on some of the homework that we gave out last week. If you can, in the chat, share 1 to 2 new things that you learned while you were looking through the Farmer's Tax Guide, while I'm going through our conclusion slides here. So again, as I'm going through our conclusion slides in the chat, if you feel comfortable doing so, share 1 to 2 new things that you learned from the Farmer's Tax Guide, and it's new to you. So it might be something that some of us is going to be new to us, or something that, you know, others might have known, but 1 to 2 things that were new to you.
So Caitlin, one question before that popped up. Barbara asked, how do farmers pay into Social Security if they don't take a paycheck?
This is a good Dayton question, because I'm pretty sure you kind of alluded to it last week. So
Yep, he did. So
Yeah.
go ahead,
So,
Dayton.
and so I'll give it a go. And then if Joan wants, I think I got it, but if Joan wants to jump into, we'll let her. So because you're self-employed, the farmer pays. So normally if you get a wage income, like on my paycheck with Cooperative Extension, the employee pays half of Social Security and Medicare, which is 7.65%. And then the employer pays half of Social Security and Medicare, which is 7.65%. As a self-employed business owner, you're responsible for paying both. So the total is 15.3% self-employment tax. And however, and as far as I understand, you're able to expense the 7.65 portion that the employer would have paid. I think that's how that works. So, and did we answer that one?
I think we did. I think you're right on.
Okay.
Jill actually says in publication 225, I was surprised that actually you are not permitted to ask for a December payment to come into January in order to push the income into the next year. You have to account for the income when it becomes available. That's more, Jill, that's more of accrual accounting versus cash accounting, correct, Deaton? I mean, you can, I mean, you can hand somebody a check, but they can, and you can use it on your taxes for December for 2021, but they could deposit that in January of 2022 and use it on next year's taxes. The only way
Yeah.
that that really happens is if you're doing the accrual method, and typically most farms only use cash accounting methods.
Yeah, so Nicole, I agree. So the cash would be counted if it was received. If it was never received, then you wouldn't count it. Where
Correct.
in the accrual method, it would be counted as an accounts receivable and count as income. So,
Right.
oh, whoever said that, yes, pay in something so you can have a income stream in retirement. Yes, way to
right.
go. Thank you.
We'll send you your commission for making that comment later on. Thank you.
Excellent.
Great. So while you guys are finishing typing in, some of the new things that you learned from the publication 225, I just want to kind of give you a preview into next week and some homework that we have for you guys between now and then. So we're going to share out, just like we did last week, the recording of tonight, the slides, and all of the handouts. Now that we have a new Pub 225, I would, encourage everybody to go back through it, especially the section where they discuss things, changes from 2020 to 2021, and see if you can find something new in there that is useful for your business. We also have been asking you throughout these two sessions to reflect on what your farm's personal tax planning goal is. Part of your homework from last week was to kind of make up a goal for you and your farm. So what we would like is for you to take in what we've discussed tonight and see if that changes anything related to your income tax planning goal for your farm. And then the last bit of homework that we have for you that is the most timely and the most valuable to you guys right away is to, in preparation for our session 3, where we are so lucky to have Paul from Farm Credit East come in, and he's going to be leading the discussion. So this is boots on the ground, business advisor, tax preparer, and he, this is his job. So what we want to have the most efficient use of his time and your time is for folks to submit questions ahead of time. That doesn't mean that you can't ask questions during the session. It's just going to make things flow even more smoothly if we've got some of the questions to Paul ahead of time to make sure we're covering those topics. So what we want for you guys to do, and this will be in your recap email too, so don't worry about writing this down, is to go to this website, tinyurl.com/CCE Tax School 3. And by Friday, this current Friday, October 22nd at noon, what we want for you guys to do is submit your questions. So it'll take you to a screen like this, and just really simple. You can type in your questions and click enter, and that's it. You can ask one question, you can ask 10 questions, whatever you would like. Just our biggest request is to have those in by this coming Friday at noon so we can get them over to Paul. So we're going to skip this bit, and I think that's all of the slides. So at this point, let me stop the share. We're going to open it up to you guys. So we'll go through kind of some of the new things that you found in the 225 and open it up for Q&A if anybody's got any questions that have popped up throughout tonight's discussion. Also, if you feel comfortable doing so and you do want to share what your farm's income tax goal might be, please go ahead and feel free to do that in the chat as well.
Caitlin, we have some questions there.
Great.
They look more like comments. Let's see here. Sandra did ask for LLCs. Can you confirm that the Schedule F flows into the 1065 rather than the 1040, and the K1 flows into the 1040 Schedule 1?
Boy, so I know, well, let's see. So the LLC, so the LLCs that tax returns that I've looked at are taxed as a partnership, which involves Form K1, and beyond that, I don't think I can tell you much more.
I can help with that.
Maybe Joan can take a stab at that.
Yeah, Joan,
I can help with
Joan,
that.
go ahead, yeah.
Yep, if your LLC is taxed as a partnership, it flows to the Form 1065, and then the K1 goes to each partner, and so the partner's shares come through to them on their K1, and the K1 is what will go on your 1040. And there'll be, there'll be probably 2 or 3 different entries for different pieces that are coming through from the Schedule F and or 4797 from the partnership. Or I'm sorry, from the LLC.
The LLC, yep.
I also did look
Yep.
at the net operating losses, and net operating losses can be carried forward indefinitely. They no longer can be carried back.
Ah,
That was a tax rule change a
Good.
year or 2 ago.
okay. Thanks, Joan. Let's see here. So somebody asked if they can get the 2021 paper copy of the farmer's tax guide mailed out without having us print. So Rebecca did ask that.
Yeah, I can, let me just write down your name. And Rebecca, I can drop that out in the mail to you. Also, in general, if you call your local CCE office, they usually can print things out for you. Just call ahead of time.
Phil asked, is the LLC capital account taxed or at K1 distribution?
K1 distribution. Yeah, the capital account's not taxed unless you exit the business or get out of business, then that becomes an issue, as far as I know.
Yeah, because the K1 acts as the flow through, right, to the personal.
Yes.
It just is a division of, right.
Yep.
Any other questions for folks? Kind of quiet tonight.
That's some really good questions early on. So
Yes, there were.
I'm going to drop the URL for submitting your questions for next week right now too, just in case anybody's got something in their brains that they don't want to lose.
Great idea, Caitlin.
Possibly going to drop that link in there. All right, so what I would say is we'll stay on until 8:30. So if you have some more questions that maybe are particular to your business that you don't feel comfortable sharing for the large group, go ahead. For the rest of you though, we're not going to hold you until 8:30. So we did save some time from skipping the break. I hope that was okay with everybody. And we look forward to having you guys join us for session 3. I would say that if at all possible, we do encourage you to join live for session 3, because that will give you a chance to ask specific questions versus recording. Our next week will be really super interactive. So if you can be there for it, great. And like I said, we'll keep it open for until 8:30, and thank you all for joining us tonight.
Thank you, everyone.
Yeah, thanks, everybody.
And no gremlins tonight.
It's not over yet.
What
I got to check to make sure the recording's there.
and thank you, Joan, for your help, for
Yes, thank you, Joan.
sticking in with us.